Right. Good afternoon, ladies and gentlemen. Welcome to our session for FAC 2602. My forgiveness. Can you please forgive me for failing to meet you during the week? It was beyond my control. But I would also like to say that next week I would like also, I think, an extended session. So instead of a meeting on a Wednesday, we'll also meet weekend for next week. I will tell you by Friday the exact time that we shall be meeting. The exact time either on Saturday or Sunday, but I usually want Saturday later, just like maybe 12 o'clock, 1 o'clock or so. I will tell you by Friday, but we would need to meet again for about 2 or 2.5 hours also next week. So I will tell you, so we'll not meet on Wednesday, we'll meet during the weekend. I will inform you on the exact date. Right, for today, my major focus will be on...
Sorry, sir.
Yes.
I'm not sure how others feel, but I'm thinking if it's a Saturday, will the also the Saturday maybe in the afternoon not work better? Because if it's Saturday and it's in the middle of, you can't do anything much in the morning because you are scared that 12 will be, you're not done, you can't start anything. So maybe the afternoons, I'm not sure how others feel. I'm just asking.
Okay, I will tell you, it will also depend on other factors, on other modules that I will be doing. So that's why I'm saying that I will inform you, because I think there will also be other modules. And actually, next Saturday, I'm supposed to be doing something in the morning, so it's likely to be a little bit late.
Okay, thank you, sir.
Okay, all right. So I will tell you. You are writing on the, is it on the 15th? What is the date of your next assessment?
I'm writing both, so I know it's 15 and 16.
13.
Sorry. On the 13th. I mean, this module specifically. Or it's on the 13th. That will be on a Tuesday or something like that.
It's a 13th.
I can't hear you.
We're writing on the 13th.
13th, okay. And I understand that it's on everything from start unit 1.
Yeah, but yeah.
So I think I might need a longer session, not even 2 hours. I think maybe 3 or so hours. Because I think I might need to also talk a little bit about the other topics. That is, they've also introduced the associates and joint ventures, but they are not done in detail. I have to introduce them. Then also to maybe do some consolidation also that we've already done, so that we can be able to understand all the things. So I will inform you, but I think I will have to have a longer session.
Do you want to have the longer session today, or would you want it in the week? Would you want the longer session today or in the week?
No, not today. I mean next weekend.
Oh, okay. Okay.
For today, we'll just do about 2 hours or so. Today, I want to focus on cash flows.
Yes.
Then next weekend, then I would need a longer session. So I'm just telling you in advance so that you know that next weekend we'll do a longer session.
Okay.
So maybe next weekend it can be 3 hours or so. I will tell you by Friday.
Okay.
Right. But if I will tell you about, okay, I'll be informing you. Right. Just a second. Right. We are going to use this example to illustrate the cash flow, but I will, whilst answering, I'll also be explaining the concepts then. Right. Cash is the blood of the business. Without cash, a business cannot operate. We know that normally our financial statements, they focus on the profits, that is reporting on the profits made by the business, the statement of financial position, but we also have cash, the statement of cash flows. in as much as we know that our profit statements, they are prepared on an accrual basis. We record revenue even if we have not yet received the money. We record expenses even if we have not yet paid. So a business can have a profit of 1 million, but without cash. For example, if most of the sales were on credit and they have not yet been collected, the profit will be very high, but the cash will be very low. They can even have an overdraft. But now, for you to run a business without cash, it can be very difficult. Your creditors might not be willing to just hear your stories that I will pay next week, I'll pay next week, I'll pay next month. They wouldn't like that. They might even refuse to provide the service to you. Your landlord needs to be paid. They can even check you out because you didn't pay. Your employees, some talented employees may leave because you're not paying your salaries on time. The creditors, they can recall their loans, or they can even sue you for failing to pay. So without cash, the business cannot run properly. So that's why there's a need to do a further analysis of the statement of cash flows in conjunction with our budgets, which will also have a cash budget. The statement of cash flows, it shows how we have generated our cash and how we have used our cash. It shows where our cash came from and how we applied that cash. Our statement of cash flows is reported under 3 headings. Right. Statement of cash flows. I will not write much so that we can be able to cover. Right. So it shows the cash that was sourced by the entity during the period. And how that cash was applied. Actually, long back, it used to be called a statement of sources and application of funds before they changed it to cash flow statement. Until now, they are now calling it a statement of cash flows. So it shows how we obtained our cash and how that cash has been used. Right, the statement of cash flows is reported under 3 main headings. Number 1, operating activities. These are the cash flows, the cash inflows and outflows from the day-to-day operations. Then number 2, we have the investing activities. These are the cash outflows from acquisition of non-current assets, and cash inflows from sale of non-current assets. That is land and buildings, furniture and equipment. We're talking about our fixed deposits. We're talking about investment in shares that are not for trading. Then we've got financing. Cash is cash received from long-term capital and long-term borrowings. and cash repaid towards capital or long-term borrowings. So these are the, so normally our focus on financing, it will be on them financing and the capital and the long-term loans. Right, my friends, we are only interested in the cash movement here. Non-cash items are necessary. We only want the cash items. When cash comes in, we show it as a positive. That is an inflow, which we call an inflow. When cash goes out, we show it as a negative, which we call an outflow. Right. So now, I'll explain through the preparation of this statement. They say normally when they ask you to do, okay, let's just read this. Zama Coffee Private Limited sells coffee beans and coffee making equipment. The following balances were extracted from the general ledger of Zama Coffee Private Limited for the financial year ended 31 March 2022. Right, normally they will show you they will give you two statements of financial position items, the ones for last year and the ones for this year. As we can see, here were given the 2021 and 2022. Then they will also give you the profit or loss. The profit or loss normally you just get for this year. As you can see that we have here the profit or loss only for this year. Right. So that's our the things that we need. Right, now let's read additional information. Zama Coffee Private Limited did 500,000 shares in issue since incorporation. On 5 January 2022, this year, Zama Coffee Private Limited issued 450,000 new shares to existing shareholders. All shares were fully paid at the issue date. So that means last year they did this, and then they issued more shares. We don't know them. We're going to find out through calculations what those shares are. And these shares were issued and were paid for. So you should be very careful when you are dealing with capital when doing the cash flow statement. Why? Because they can be what you call a bonus issue, which we learned in 2601, whereby shares can be issued to existing shareholders for free. Now, these shares do not involve cash. So when we are doing cash flow statement, they are not supposed to be indicated. But these ones now, they are saying the increase in cash was as a result of shares that were issued. So we should be able to calculate those shares at a later stage. Then the following information was obtained from the statement of profit or loss and other comprehensive income. That is the statement of profit or loss. You see where we're going to use it. Then other income consists of the following. There's dividends received, fair value gain, interest received, and profit on sale of financial assets. 132,600. So this is the 132,600 here. That is the other income. Right, I'm going to explain where all those things go. Included in other expenses are the following balances amongst the various others. Depreciation and credit losses. Right. Included in trade and other payables is the following: income tax payable. Then number 4, on 1 August 2021, the land was valued at 1.5. Zama Coffee Limited purchased the new land for expansion purposes on 1 September 2021, financed through an increase in the long-term loan. Interest on the loan is payable annually in arrears, and it does not qualify for capitalization. No other revaluations or purchases took place in land and buildings during the current financial year. So that means this land and buildings here, it went up from 1,350 to 1,875. There were two things that happened. There was the acquisition, which they used a loan, the increase in the loan. If you can see, the loan increased from 531,200 to 791,200. Then there was also revaluation. Remember that a revaluation does not affect cash flows. A revaluation is simply a qualified person comes and tells you that your building has gone up. It was 5 million, it's now 5.5 million. Right. So we should be very careful. A revaluation does not involve cash. Number 5, the company sold a portion of financial assets in the current financial year and proceeds amounted to 150,000. The company's financial assets are held for trading. Right. Financial assets can either be accounted for under operating activities or under investing activities. How we classify them depends on our business model. If the financial assets are held for trading like these ones, they will be accounted for under the operating activities. And if they are not for trading, they will be accounted for under the investing activities. So our business model will determine whether the financial assets will be accounted for under the operating or under the investing. So in this case, this will be under the operating activities. Right. A data Mr. Cappuccino paid his account of 9,300 on 15 September 2021. The accountant recorded this transaction twice. So we should remember to correct that. It was recorded twice, this amount. That means our bank should be reduced by the 9.3 and our data, sorry, our bank should be reduced, yes, and our data should also be reduced by 9,300. So we should remember that. Right, on 30 November 2021, an interim dividend of 25 cents per share was paid, and the final dividend of 50 cents per share was declared on 15 March 2022. That's the dividends. Now prepare the statement of cash flows of Zama Coffee Private Limited for the year ended using the direct method. Right, you can either prepare using the direct or indirect method. Right, we use the direct method when we are, sorry, the direct method or the indirect method, they only affect the operating activities. There's a small section on the operating, not all the operating activities, only a section of the operating activities. Otherwise, the investing and the financing, they are the same, whether you are using the direct or indirect method. So I'm going to show you both using this question, the direct and the indirect method. Right. So I'll move on to the statement of cash flows. Right. I will be explaining as we go how I derive those things. And please have the grace to stop me if you feel that this man is now talking in tongues which we don't understand, so that there can be interpretation. Right. Normally we need 2 columns when we are preparing the full cash flow statement. So that means when you are recording the items under the operating activities, you record in the first column, then the total goes to the second column for each activity. Right. So now, right, we would start with the operating activities. When using the direct method, we start with the cash received from customers. We start with the cash received from customers. Now, our cash received from customers will be made up of the following: cash received from sales, that is both cash and credit sales. Right. So we are not interested in the full credit sales, only the cash that was received on those credit sales. So even if the sale happened last year and the sale was received this year, it will be in the cash flow for this year. We want all the cash that was received this year. And cash received from incomes, other income, excluding dividend income, interest income, and non-cash income. Right. I think other income, we're told that it includes the following, my friends. So we don't include dividends. We don't include interest because they're included elsewhere. Fair value gain and profits on sale of non-current financial assets, those are accounting adjustments which do not affect cash. So we don't, so on other income in this particular question, we don't have anything. What are the other income that can be there? Things like rent received, commission received, would include them in our cash received from customers. So you don't include the non-cash items and also things like dividends and interest. They've got a special place where we're going to account for them. Right. So to calculate this, you would take your revenue, that is your sales, add trade receivables, last year. But you should remember, if there are any that pertain to interest, you have to take them out, or dividends. Right. Trade receivables, last year we add, because remember that trade receivables is a current asset. So if they were receivable last year, that means they were received this year. We received the cash this year. So we add less trade receivables this year, less trade sales, add other income, of course, excluding non-cash income, dividends, and interest. Right. Then you add prepaid income this year. Relevant income. When I say relevant income, I mean the income that I've said, the rental income, commission income. We don't include that, is what if do interest. Less prepaid income last year. Because if it was prepaid last year, that means the payment happened last year. Right. A less accrued income this year. Add accrued income last year. Right. Only if it pertains to that income that I talked about. That is the things like rental income, commission income, and stuff like that. So in this particular question, these things are not there. I'm just giving you in general. So our cash received from customers for this particular question, we're only going to have these three things, these four things. Right. So let's do our calculation here. My learned colleagues. Right. We have our revenue. We have it here from our statement of profit or loss, which is 3201800. Right. Then we have trade receivables for last year, which is 2021. We'll add them because we're saying they were received during the current year. If they were receivable last year, that means our assumption is they pay within 12 months. So they were received this year. That means they 162,500. Then we subtract the trade receivables last year, this year, sorry. But remember, we have to, they said that our receivables were the 132,600, but they recorded twice this payment by a data, Mr. Cappuccino had paid his account of 9.3. The accountant recorded this transaction twice. So that means the payment was recorded twice. Remember, when you record a payment, you reduce data. So that means the data were reduced twice instead of just reducing once by 9.3. So we have to add back the other payment, which was wrongly recorded, the 9.3. So we're going to say I now see that when I explained, when I was reading the edition for me, I said we reduce our data. Our data are supposed to go up. Because we're saying there was a payment which was not made, which was unfortunately subtracted. So we'd say 132,600, 132,600. Then we add back the 9,300 because this payment had been recorded twice. What do we get?
Mr. Kamanga?
Yes, my boss, Big J.
I just wanted to know that this 9,300, are we adding it or are we subtracting it because of we have recorded it twice? When
you record a payment twice, well, right, what is the effect of a payment on your, when you record a payment, what happens to your data?
When I pay twice.
No, the person did not pay twice. The person paid once.
But then
the recording was done twice.
I need to subtract that.
No, they subtracted, isn't it? When someone pays, you subtract.
Okay. All right.
So that means when they say they recorded twice, that means they subtracted the data twice.
Oh, yeah. Oh no, now I'm getting you.
So to reverse one of the payments, we have to add it back to the data.
Yes.
Because they'd wrongly deducted twice.
Okay.
Instead of just deducting once.
Yes.
Okay. Thank you,
Thank
Big
you.
J. Right. So that's 141,900. So you should be very, very careful when reversing some of these things. Because a reversal is not always that when you take out, you have to subtract. Sometimes you have to add back, like especially for expenses. When expenses had been wrongly included, for you to reverse them, you have to add back. Right, so that will be this. But then some of this revenue was not, we didn't receive the money. That's what we call what? Credit losses. Remember, credit losses are bad debts. That means some of the customers failed to pay. We had credit losses of 5621. Credit losses. That means these are sales that we didn't receive the money. So we have to take them out because we didn't receive the money. Negative 5621. Right. So then we get our cash received from customers. So if we had those other items like commission received, rental income received, they're also going to be added here. And we're also going to also account for the accruals and prepayments. So this is how we get our cash received from customers. Any questions on the cash received from customers?
So how do we know the credit losses isn't already included in the revenue?
How do you know what?
The credit losses is not already subtracted from that 3201.
In accounting, you never subtract credit losses from sales. They are never subtracted from sales.
Oh, they are added as an expense. Yeah.
Yeah.
Okay.
So it's definite that they're not subtracted from sales.
Okay, so you use the counting. Yeah, you basically just use.
Yeah, because remember these are financial statements, so they were prepared according to accounting.
Okay. Okay, so if there's credit losses, it's automatically not included.
So it's definite that the credit losses was included in expense. When we prepare financial statements, you don't subtract the credit losses from the revenue. So if they give us financial statements, our assumption is that they are prepared according to International Financial Reporting Standards. So the sales relating to those credit losses are within the sales.
Yeah, and it's deducted later. Okay.
Okay.
Thank you.
Thank you, sir. Then cash paid to suppliers and employees. Right. When we are recording the cash paid to suppliers and employees, right, we include cash paid for purchases. Right. Normally, we are not given the purchases. So we have to do a calculation. To get our cash paid for purchases, we normally start with our cost of sales. Right. Then to our cost of sales, we subtract our opening inventory. Why? Remember that opening inventory will be part of the cost of sales. But our opening inventory was not purchased this year. It was purchased in the previous year. So that's why we have to reverse it. Right. Then we add closing inventory. Why? Because closing inventory is not included in cost of sales. Remember, when you calculate your cost of sales, you subtract the closing inventory. You will be taking it out. But the closing inventory will have been purchased this year. Right. Then you add trade payables for last year. And make sure that you are adding those that are relating to purchases, not the ones relating to tax, not the ones relating to interest and stuff like that. Then less trade payables this year because we're saying they've not yet been paid. Then add other expenses. That is wages and salaries, rent, and stuff like that, except non-cash expenses, such as depreciation. The value lost on the financial assets. Right, also excluding tax, interest, because they are recorded elsewhere. Then we also add accruals last year related to this expense. Less accruals for this year. Add prepayments for this year. Less prepayments for last year. So this will give us our cash paid to suppliers and employees. Right. So here we would start from our cost of sales. We have our cost of sales here, which is 2241,260. Right. So we'd say cost of sales that's 2241,260. Right. Then we remember that the inventory last year we subtract, and the inventory this year we add. Right. Our inventory last year, which is yeah. So the 215,200 we subtract, and the 202,151 we add, which is the one for this year. So we'd say the inventory for 2021 we subtract, which is the 215,200, and the inventory for 2022 we add, which is the 202,151. Right. Then the payables. Right. The 162,500 for last year we add, because we're saying it. Sorry, the payables, not receivables. The 121,200 for last year we add because it was paid this year. The 138,500 we subtract because it's not yet paid. But let's remember additional information number 3, which says included in trade and other payables is the one for tax. we take out the portion that relates to tax. So for 2021, we're going to say trades and other payables 2021. We'll take our payables, which is 121,200. Then we take out the portion that has to do with tax, which is the COF 100. What do we get? I'm waiting for you.
109, 100.
109, 100.
Yes.
We add. Because we're saying these were paid this current year. Right. Then we'll have the ones for 2022, which will subtract because it means they have not yet been paid. We'll take the trade payables, which is 138,500 minus the 18,500, which relates to tax.
120,000.
120,000.
Yes.
Right. Then other expenses. Right. Our expenses, they were 196,100, but they included these two. They have to be taken out. Why? Depreciation is a non-cash item. It's just an accounting adjustment. Credit losses, it has already been included in the determination of the cash received from customers. So our other expenses, we're going to say the other expenses on the profit statement, which is 196,100. Then we take out our depreciation, which is 38,100. Then we take out our credit losses, which is 5,621. What do we get?
$186,669.
Right. But I saw that there are other expenses that we have there, which are also included here. If we check here, there is the admin expenses. It is also included there. We don't include the finance charges. Finance charges is interest, we don't include it. So we would also include the administrative and selling expenses. Administrative and selling expenses. I think, yeah, I just said other expenses simply because most of the time they give you other expenses. So here maybe to correct this, let me just say expenses excluding these ones, right? Admin expenses, then we'll have our 25,320. Right, let's just check if we have anything because we don't want to leave anything, so because that will give us a lot of labor if we make a mistake. Please, yes.
Can you please go back to the spreadsheet?
Okay, let me just check something, then I'll come back to you.
Okay, sure.
Yes, we're back.
Okay, I don't think that that answer for other expenses are correct, because 196 100 minus 38 1000 already it should be somewhere in 160 something. So I don't think that 186 is correct.
That's definitely wrong. I can see that also. I think there's a mistake there. Can you recalculate that? But I think it should give us 140 something, I think, if I'm not mistaken. Thanks, sir.
Okay. I'm getting 152,379.
Thank you so much, sir.
You're welcome.
I think maybe our colleague added a certain figure, or maybe left out something there. Right. Okay.
I forgot to add instead of this one of 38,100. I said 3810. This one. Sorry.
Okay. Okay. Thanks, sir. Right. I think that's all. Then we get our total. So yeah. Right, that's our cash received paid to suppliers and employees. Right. At this stage, I would ask if there are any questions on that part. Right. So that's it. Then you get what we call cash generated from operations. Which will be the difference between these two? Right. So if it's negative, you don't call it cash generated from operations. You would call it cash used in operations. If it's negative, you would call it cash used in operations. Right. This is the only section that differs whether you are using the direct or indirect method. That is the only section that will be different. Otherwise, everything else from now onwards is the same, whether using the direct or indirect method. Everything else that I'm now going to look at from this stage will be the same, whether you are using the direct or indirect method. Right. Then that's not the end of the operating activities. Then under the operating activities, then we'll have to account for the following. Interest received, if any. Interest paid. Dividends received. Dividends paid. But for some entities, dividends paid may be included under financing for some entities, but not always. Right. Checks paid. Sale of financial assets. Held for trading. And we call it proceeds. Then acquisition of financial assets held for trading. So these things will be included. Right. We should know that for all income and expense items, we add payable last year. That is whether for interest or for tax, and less payable this year. That means it's not yet paid. Add receivable last year less receivable this year. Add prepaid this year less prepaid last year. So for each and every item, we have to check if we have any of these. All right, so now if we check on other income, we are told that it includes dividends received and interest received. These have to be included. Fair value gain is a national cash item, we don't include it. Right, so we check if there were any prepaid or received relating to these things. If we can see there's nothing there, we don't have anything to do with this, with these items, so we take them as they are. So that means our dividends received, interest received, if it's money coming in, you put it as a positive. That means it's 18,500. Dividends received, it's 19,100. You take them as they are. There's no receivable or payable. Right. Then I'll move on to the interest paid. Now my interest paid, we have got we have the interest, the finance charges here of 6,200, but we have got the accrued interest of 16,200 for this year and 15,100 for last year. That means it's unpaid. The accrued for last year we add, because if it was accrued last year, it means it was paid this year. Then the accrued for this year we subtract, because it means by end of year it has not yet been paid. So we're going to say that's the payable that I was talking about. So we'll take here under the interest paid, we'll take the interest expense, that is the finance charges under the statement of profit or loss, which is 6,200. Then we'll add the accrued interest for 2021, which is 15,100. Then we'll subtract the accrued interest for 2022, which is 16,200. What do you get?
$59,100.
And we put it as a negative because this is a payment. Right. On the dividends paid, we know that the dividends were told that they were on 30 November 2021, there was a 25 cents per share dividend. Then on 15 March 2022, there was a 50 cents dividend. Now, new shares were issued on 5 January 2022. When these new shares, these 450,000 shares were issued, if you can check, the interim dividend of 25 cents had already been paid on 30 November 2021. So that means the interim dividend was only paid on the 500,000 that were there from the beginning. Then the other final was then paid on the total of 950. Right. Then, so your dates are very important. Then we also have to add the dividends payable from last year, 62,000, and subtract the dividends payable for this year, 52,000. Here, the dividends payable. So for our dividends, I want you to follow me here. Maybe let me do a calculation somewhere here. Dividends paid. We have the interim dividend. Interim dividend is a dividend that is paid during the year. So that was 25 cents multiplied by 500,000, because they did not yet, in November 2021, they did not yet issued the other 450. What do we get?
$12,500.
5,500.
No. Sorry. Let me just. I forgot to. I made it
I think it's 125,000.
Yeah, 125,000.
Right. Then final dividend. Now this one will now be paid after the new shares have been issued. So 0.50 multiplied by 500,000 plus the new shares 450,000. Please, if it was a preference dividend, we're going to prorata. Remember from our previous studies that a preference dividend is prorated. But now this one is not a preference dividend, so there's no need to prorata. Even if they were issued in January, they will still receive a full year's dividend when the final dividend is declared. What do we get?
For 75,000.
For 75,000. Right. Then we'll add our dividends payable for 2021. Which is 62,000. Then we'll subtract the one for 2022, which is 52,200. Then we get the actual amount that was paid for dividends. So which is any questions? Right. Then our tax paid. We'll take the income tax expense, which is 225, 250. Then we add the payable from last year, because what we owed SARS last year, that means we paid this year, and subtract the payable for this year. So say, but if it's receivable, it will be the opposite. So sometimes it can be receivable, so it will be the opposite. Right. So I would say 225, 250. Then we add the payable for last year, 12,100. When I say opposite, I mean the receivable for last year, we're going to subtract. Then subtract the payable for this year. Then if it was receivable for this year, we're going to add. What do we get?
21,850.
It's what?
218.
28.
Yeah, it's 218. 218.
Okay,
21.
thank you. Thank you, guys.
218.
850.
Yes.
Right. Right. Then we have to look at our financial assets because they said they are for trading. If they were not for trading, they were going to go to investing activities. But here we're told that the company financial assets are held for trading. Now the financial assets, you just have to check the increase or decrease. So if you can see this one, increased from 550 to 765. So that increase is the acquisition. Then we take out the increase that was due to what? Did they say they sold? They sold a portion of the financial assets during the financial year. And they were sold at a profit of 15,000. So we can say to get for you to get the proceeds from the sale of the financial assets, we'll have financial assets (2021) or last year. Let me just put in general. Add fair value gain on investments, or less fair value loss on investments. Right. Then we say less financial assets this year. Add profits on sale of financial assets. Less loss on sale of financial assets. This is how you determine the proceeds that were received from the sale. Let me put all. Where I put all, you can't have both of them. You can only have one. Right. So our financial assets last year, we have these ones here. Last year, they are 550, and this year, they are 765. So we'd say 550,000 is that fine? Right. Then the fair value gain were given here on the other income. There was a fair value gain of 80,000. So here, that's 80,000. I think there's something that I'm missing here. Maybe let me just check properly. Oh, I think there's something that is wrong there. I had not seen that they said the company sold a portion of its financial assets in the current financial year and proceeds amounted to 150. So it's already given. There's no need to calculate this one here. Sorry about that. So we have the proceeds from sale of financial assets, which is 150. But instead, what we have to calculate is the acquisition. So if we are calculating the acquisition, we don't calculate in this way. So the proceeds from the sale were given. There was no need to calculate. So let me just delete this. Acquisition of financial assets. So in your exam, it's not possible that you don't have the acquisition and you don't have the proceeds. There should be one given. So if we're not given the proceeds, that's when we're going to use what I was doing here. But the proceeds are given. So instead, we have to calculate the acquisition. To calculate the acquisition, you say financial assets this year less financial assets last year less fair value gain. Or add fair value loss. You can see that it's almost opposite to when you are calculating the proceeds. Right. Add carrying amount of financial assets sold. Sometimes it's not given, of which you would say proceeds from sale of financial assets less profit on sale. Or add loss on sale. So this is how you get your acquisition if it's not given. Please, you only use these formulas if something is not given, then you are trying to determine it. All right, our financial assets, we have here, for last year, we know that our financial assets were 550. And for this year, they are 765. So we'd say 765,000, 550,000. Right. Then we are given that the fair value gain was 80,000. Less 80,000. We don't have fair value loss. Then we have proceeds were 150. Then profit on sale, 15,000. This will give us the acquisition of financial assets. Which is 270. That means they bought financial assets of 270. So here it will be acquisition here, negative 270. Acquisition you'll be paying. So that's why it's a minus. Right. Then after accounting for this, that's when we get the net cash inflow or outflow from operating activities. We add from here, from the 821, we add everything. If it's negative, we'll call it, maybe let me put it here. It's negative. So if it's negative, we call it net cash outflow from operating activities. If it was a positive, we're going to call it net cash inflow from operating activities. Any questions? So this part does not differ whether we are using the direct or indirect method. It will be the same. Any questions? Right. Then we'll have our investing activities. Investing activities is made up of 3 parts. And also you should know that the purchase and sale of those investments, financial assets, we're going to be on the investing activities if we didn't have, if they were not for trading. Right. We first have what we call investment to expand operations. This is when the entity buys assets so that they can grow. So these are new assets that are bought without improving, but just expanding. Right. We were told that on 1 August, the land was valued at 1.5. Zama Coffee purchased the new land for expansion on 1 September, financed through an increase in the long-term loan. So we can go to the increase in the long-term loan and find out for how much the acquisition took place. Right, the long-term loan increased from 531 to 791,200. So we can have acquisition of land and buildings. Right, so we'd say we'll take that loan because they said we are using the loan because they said it was paid through that increase in the loan. We are following that instruction. So 791,200 minus 531,200. What do we get?
To 60,000.
60,000.
2, 6.
Thank you. It's a minus because we're acquiring. Right. If these investing activities were not for trading, the investments, they're also going to come here. Right. Let's check if they bought other assets. Did they buy other assets here? They are motor vehicles. We don't know this figure, but we can find it because we know that this is 361 and we can take out everything here to see what is the motor vehicles at cost. So our motor vehicles at cost would say 3631 333 minus 1,875,000 minus 765,000 minus 202,151 minus 132,600 minus 603,382. What do you get?
5320.
It's what?
53200.
53200.
Yes.
Right. So what does that show us? If you can check last year, the motor vehicles were 53200. So that means they didn't sell the motor vehicles and they didn't buy motor vehicles. The motor vehicles have remained the same. So if they'd gone up, that would have meant that they've bought. So we're going to include a further amount there. If they'd gone down, that would have meant they've sold. Right, so there's nothing there. So I think that was the only investment. We don't have anything else here. I don't see other assets, so that is it. So our, we only have this acquisition of land. Right, you can also have in other questions what we call investment to maintain operations. When we are saying investment to maintain operations, this is when you replace assets that were damaged. They can tell you that, for example, that in a vehicle had an accident and they had to buy a new one to replace the vehicle that was damaged. That would be investment to maintain operations. Right, so that is net cash outflow from investing activities. Which is equal to this one here. And also we include proceeds if they sold any assets there. They can tell you that they sold land, for example, they sold equipment and stuff like that. Right. Then we have, I think next week I'll make sure that I've got a question that has got a lot of things on the investing and financing. Right. Then we also have financing activities, which is the acquisition and repayment of capital and the long-term loans. Right. Our capital, we don't know it. We only know that they issued shares. Our revaluation surplus, we don't know it. So, but we can find them. Both we can find the revaluation surplus. We can find the accumulated depreciation. Right, let's find the revaluation surplus. Let me just do them here. Our revaluation surplus, my friends. We know that our land is now 1875 from 1350. Part of the increase was due to acquisition, which we calculated to be 260. The remainder was due to revaluation. So we can take the land for this year, 1,875,000, then subtract 1,350. Then we subtract the portion that was due to acquisition. What do we get?
To 65,000.
65,000.
265.
265,000. So that was the revaluation that they did. So our revaluation surplus 2021 this one is the revaluation surplus for the year. So that means it will now be the balance that was there last year, which was 625 plus the one for this year. So we would say 625,000 plus 265,000. What do we get?
890.
850.
890.
90.
Yes.
Thank you. So that will be our revaluation surplus. So that is the missing figure there on the revaluation surplus. This one here. It's this one here. Then the accumulated depreciation. We know that accumulated depreciation, it's end of year. You take the accumulated depreciation at beginning of year. At depreciation for the year. Less accumulated depreciation on assets sold. Right. Our accumulated depreciation at the beginning of the year is given here. It was 5.5. So here we have got 5.5. The depreciation for the year, we have it on additional information number 2. It was 88,100. I think there was it all on this? I think I have to check if I'm leaving something out here. I think that's the only one. 38,100. There is no accumulated depreciation on assets sold, considering that they didn't buy, they didn't sell any asset. Is that right? Then I think I saw something again. Part of the depreciation, part of the depreciation is for the buildings. So please, let's take out, instead of putting the whole 38,500, let's take out the portion that belongs to the buildings. If you can see, the accumulated depreciation for the buildings moved from 45,800 to 78,400. So there's part of the depreciation that belongs to the buildings. So we should take it out. So instead of doing this, we would say, can I correct this one here? Would say 38,100 minus the one on buildings, which is 78,400 minus 45,800. What do we get?
$5,500.
And there's nothing on assets sold. So that means the accumulated depreciation on the vehicles is actually 11,000. That means it is 11,000. Any questions there? Right, no questions. So that means we now know this figure here. We now know these two figures. This one. So we can now find the share capital by simply subtracting everything from the 363,133. So we can say share capital 2022. We're going to say the total 3631 333 minus 818833 minus the revaluation that we got 890,000 minus the accumulated depreciation which we got 11,000 minus 78400 minus 791,200 minus 138,500 minus 16,200 minus 52,200. What do you get? It's what?
35,000.
It's what?
835,000.
Like this?
Yes.
Right. So that means our share capital, when they issued shares moved from 500,000 to 835,000. So that means there were proceeds from issue of shares, which is the difference. So would say proceeds from issue of shares, 835,000 minus 500,000. If there was a bonus issue, you're going to subtract the bonus issue, but there's no bonus issue in this case. So that will be 335,000. Right. Then we also have proceeds from long-term loan. Remember, they received a proceeds from long-term loan, which they used to acquire a land. But remember, before you buy the land, you first receive the loan. That was the increase of this loan here. So that is the 791. We've already calculated it, but I'll just repeat. But if any in an exam, there will be no need to repeat the calculation because we already did it here. 260,000. Remember that there will be two flows of that amount. First, we receive the money, then we use it to acquire the vehicle. So financing will be, you'll be looking at the capital and long-term loans. Right. So then we get our total here. Right. Let's cash inflow from financing activities. Right. That's an inflow, so it will be positive. Right, then we add up the 3 columns, that is the operating, investing, and the financing. If it's positive like this, it's called a net increase in cash and cash equivalents. If it was negative, we're going to call it a net decrease in cash and cash equivalents. Right, then we'll have our cash and cash equivalents at the beginning of year. Right, our cash and cash equivalents at the beginning of year, you go on your bank. That means at the beginning of the year, it was 407,463. So they have 407,463. Then we get our cash and cash equivalents. It's end of year. Which is 594,082. Then you compare to the one that we have, 603,382. Remember that we have to subtract 603,382 minus 9,300. Can you say 603,382 minus 9,300 and see what you get?
Can you please repeat the numbers, sir?
This one here, 603,382. Can you see it here?
Yes.
Then can you subtract the 9,300? Do you get this?
594,082. So
that means our cash flow is fine. Is that right? Maybe let me just put it here. That is 603,382 minus 9,300. So if we don't get when you get this, if you don't get the one for this year, that means there's a problem somewhere. That's our statement of cash flow. Any questions? Right, let me quickly show you the cash generated or used from operations using the indirect method. Cash generated or used from operations. Right, you start with your profits. If you have before tax, you start with the before tax. Before tax. Then adjustments. Interest expense. If it's an expense, you add because it's a reverse process.
Mr. Kamanga?
Yes.
If I may understand, this one is an indirect method, ne?
Yes.
Okay.
So I'm just, okay, let me just show that this is indirect method. We are already done with the cash flow. But remember that we're using the direct method, which was asked on the question. But you can be asked to use the indirect method. And as I said, the only part that will be different is this one here. So this is the one that I want to show you if you are using the indirect method. Otherwise, from this 18,500 going downwards, everything will be the same. Right. Then less interest income, less dividend income, it's depreciation, it's amortization, it's fair value loss on investments, it's loss on sale of non-current assets. Less profit on sale of non-current assets. Add loss on sale. Oh, I put it. I'm about to repeat here. Right, so you look for these things if they are there. Right. Our profit before tax, we have it here. It's 8,115.20. Right. If you don't have the profit before tax, but you have the profit for the year, you also have to add back the income tax expense. But here we're given the profit before tax, so there's no need to start from the profit for the year. So 8,115.20. 8,115.20. Right. Interest expense, we have it here. The finance charges, which is 6,200. Interest income, we have got it here, which is 18,500. We subtract it. We're reversing, so incomes we subtract, expenses we add. Dividend income, we also have it here. Dividends received, 19,100. We subtract. Depreciation, we add back. We have got it here, 38,100. We don't have amortization. So if it's not there, you don't have to include it. We don't have fair value loss on investments. I think I didn't put less fair value gain on investments. Right. Loss on sale of non-current assets, we don't have. Profit on sale of non-current assets, we have it here. No, we don't have it. But we have profit on sale of financial assets, 15,000. So fair value gain on investments, we have it, which is 8,000. Okay, we have profit on sale of non-current assets, the 15,000. Remember, invest. This one, no, so this one's not a non-current asset, it's a current asset. So let me just put here that you should add loss on sale of financial assets, which is 0 in this case. Then less profit on sale of financial assets, which we have it's 15,000. Right. So these will be our adjustments. Right. Then you get your profits, the adjustments. Right. Then we'll have what we call movements in working capital. Now, with movements in working capital, let me just check if we didn't leave out anything so that we don't come back again. All right, movements in working capital, you look at your movements in trade and other receivables, trade and other payables, and movement in inventory. All right, under the movements in working capital, right, increases in current assets, is an outflow. Increases in current assets is an inflow, because it will mean that we've realized the increase in current liabilities is an inflow. Decrease in current liabilities is an outflow. Right. So here would analyze our current assets. And on our movements on working capital, we don't look at cash and we don't look at current assets and current liabilities that have to do with dividends, tax, and interest. Only those that have to do with trading inventory, trade and other payables, and trade and other receivables. Right. If you look at our trade and other payables, they increased from 121 to 138. But they included this 18 and this 21. We have to take them out. So we'll have to have our increase in trade and other payables. Right. Increase in trade and other payables. But we have to take out the portion that has to do with what? With tax. Right. So that is equal to the payables for this year, which is 138,500, minus the one to do with tax, which is 18,500. Then we subtract the one for last year, which is our payables for last year, which are 121,200, minus the one that has to do with tax, which is 12,100. What do we get?
$15,300.
15,300. So that's a liability. You said what?
13.
Okay. It's a liability which is increasing, so it's a plus. Right. So that's it. That's how we account for the trade and other payables. Right. Then, so you take out if there's anything to do with interest, if there's anything to do with tax, you take it out, or dividends. Right. Then, if there were accruals for things like wages and salaries, we're also going to include them here. But we don't include accruals and prepayments for interest, for dividends, and for tax. But any other accruals or prepayments for other expenses will be included. Right. Then we've got in inventory. Inventory, there's a decrease in inventory, if you can say, from 215 to 202. So decrease in inventory, that's an inflow. That is 215,200 minus 202,151. What do we get? Right, what do we get? 13,049. So that's a plus, because that means we've realized the inventory. Then we go on our trade and other receivables. They decreased from 162 to 132. And let's remember to adjust the 132 for this year with that 9.3 that was recorded twice. So we have decrease in trade and other receivables. We have that is 162,500 minus 132,600. We add the 9,300. Remember that we have to top up because they recorded the payment twice. What do we get? And again, that's an inflow because the trade and other receivables are going down.
$39,200.
39.
Yes, 200.
Okay. So then we'll now get our cash generated from operations. $8,427.69. I think there's something that is missing there because here we're at 821. There's something that is missing there. I think there's a figure that I left out. Let me just quickly, I think I see that is 21,000.
Hello, Miner.
Hello?
Can we please also check the last calculations? I'm not sure about that amount.
This one?
Yes, please. Can we just double check it?
Yeah, can you please do that for us? Even
Yes,
me, I think it's wrong. I think it's wrong.
Yes, I think it's wrong. The thing is, I'm not too sure about my calculations because I'm using
can others also redo it? Please remember there's a bracket between the 132,600 and the 9,300. So I think the Big J, you didn't put the bracket there.
Okay.
What do you get?
Sorry, I didn't put the bracket. It's 162,500.
162.
Yes, 500.
Yes, minus 132 plus 9.3. What do you get?
Oh, okay. So
I think the answer that you should get should be around what? 20 or something like that.
I'm getting 2 0 0. I'm not sure.
You're getting what?
Yeah, it's 2,600.
20,000.
Yes,
Yes, 20,600. Yes.
Then that one is 821769. I think that's one of the mistakes, but there's still another one. There's still another one. Let me just quickly check it. Can you also be checking?
Okay.
All right, let me just check. I see this one is also wrong.
Yes.
I'm getting 10,900.
Yes, also myself.
So that was the mistake. You see now it's 821769, and this is 821769. So this one, that is which had these calculations here, this one and this one using the direct method will now be replaced by this. So this 10,900 was the problem, right? So this is the indirect method now. Any questions? Right. If we don't have any questions, then we'll meet next week. So for Wednesday, I'll tell you on the group, but most probably to be Saturday. But if I feel that I need maybe a short one, I will tell you on Wednesday. Thank you so much. God bless you richly and enjoy your weekend. Sorry for disturbing your weekend. And I will disturb you again next week.
Okay.
For the last time.
No problem.
Thank you so much and God bless you richly.